So we had quite a negative week in the stock market. You can see that S&P 500 was down about 1.41%, QQQ was down 2.27%, and Bitcoin was surprisingly up a bit, about 0.89%. And this is actually because Bitcoin already gave up most of its gains at the starting of the year. I think it actually started to dump before the QQQ and the SPY, and from the peak to the bottom it was down about 30 plus percent. Yeah, so I think maybe Bitcoin is already kind of done with the downside, and we did actually kind of close the week out neutral at about 0.89% as I'm recording this video. And one key thing to take note of for the past week is that you can see Netflix is up about 4.41%. So yeah, this is actually quite a bad sign for the market. And the reason behind this is that people are now fearing a recession due to the Trump tariffs and basically kind of the hawkish tone that the Fed had in the starting of the week or in the middle of the week. So I'll go through the news later in this video, but yeah, basically the Fed said that they would not be adjusting their policy until they get more economic data, and that came out as a hawkish. And the banks also increased their chance of recession also to about 45% if I remember correctly. So basically all this bearish news is hinting at the chance of a recession, together with the Trump tariffs as well. Like the increase in tariffs will lead to a fall in demand, which will lead to slow economic growth and hence a recession. And what do people do when it's in a recessionary time? They usually don't go out and watch movies at the cinema. They cut back on their spending and they prefer to stay at home and watch Netflix the whole day. So yeah, you can see that Netflix stock actually went up 4.41% for the week, as people are expecting a more recessionary time ahead, and for people to consume more Netflix content rather than other sources of entertainment. Yeah, so overall quite a bearish week for the stock market. Meta is also down about almost 13%. Google is down about 3.5%, and Microsoft about close to 4%. Yeah, and we do have Apple actually up about 4%. Nvidia is down 7% due to the tariffs. And yeah, so just overall a very bearish week for the stock market. A lot of recession fears going around right now. Yeah, so right now for the current economic and world news, China basically raised the duties on the US goods to 125%, and they also said that they won't respond to any further US tariffs. Yeah, so basically this has been a back and forth game for the last couple of months. Trump raised his tariffs on China, and China retaliated by raising their tariffs as well. And right now they said that basically they won't increase the tariffs anymore, as it would have no economic significance. So yeah, basically, I mean, these numbers are kind of pointless right now. You might as well just increase this to 1,000%. Yeah, so we are still waiting for a resolution of this event, and hopefully they are able to resolve it soon, as you guys know that the high tariffs would eventually be passed on to the consumers, and the demand would fall for the prices, which would slow economic growth and basically lead to a recession. Yeah, so to add on to the previous point over here, you can see that the chance of recession is now up to about 45%. So the banks have re-evaluated the chance of a recession, and right now they have placed it at about 45%. So like I just mentioned, the tariff would be passed on to the consumer. They would probably buy less, lower demand, less economic growth, and therefore we will just get a recession. So yeah, this is the current headline news that has been floating around, that many people are afraid of a recession, and they are basically flocking to safe haven assets such as gold. And you can see that the US stock market did actually perform negatively over the past week. Yeah, so the aggressive US tariff policy will trigger a significant slowdown in the US economy, and this has led to a lot of fear and uncertainty in the market right now. The sentiment is incredibly weak, and the households are very nervous about spending. So naturally, when they're nervous about spending, they will probably consume less, lower demand, and therefore a recession. And the job market is also pretty bad right now, as companies are readjusting to this new tariff policy. Yeah, so overall the tariffs is very bad for the economy, so hopefully we do get kind of a resolution between the US and China situation soon. And we also are in a very weird state right now of stagflation. So Jerome Powell spoke on Wednesday, and he said that he cannot actually adjust any policy yet, as he's still waiting for further economic data. But he did mention that the Trump administration's trade policy is not a sign of stress that warranted a Fed response. And he said that he's basically waiting for more economic data regarding the inflation rate and the unemployment status before he can actually act. And yeah, so he said that the tariff situation is actually pretty bad, as both growth and the labor market would weaken. So we would actually kind of get inflation and low employment. So this would actually lead to stagflation. So yeah, everything is not actually doom and gloom. We do have some good indicators that are actually signaling a potential recovery in the stock market in the upcoming few weeks. So in this segment, I'll just go through about 3 indicators that suggest that we could be actually at a local, maybe not a macro bottom, but at least a local bottom where we might actually get a short-term rally in the coming few weeks. So the first thing to take note of over here is the flows into the money market and cash ETFs. So you can see that this is basically a contrarian indicator over here, and you can see that once the chart passes this threshold over here, it has actually signaled a local bottom for the stock market. So this indicator is obviously not 100% accurate. You can see that in 2022 we did kind of have a double bottom, and even though the indicator did pass through the threshold, it was not the actual macro bottom. It was just a short-term rally into the resistance before we had another sell-off back down to kind of form this double bottom over here. So yeah, it is not really the kind of the macro bottom indicator, but it does suggest that we could actually be at a short-term bottom and there could be a rally in the coming few weeks. So what this indicator is that it's just basically tracking the flows into the money market funds. So if you use Tiger or Mumu, you have those funds that you can invest in, and the funds will take your money and invest it into T-bills or other like treasuries or basically safe haven assets. So when investors are fearful, they normally take their money out of equities and they invest it into this money market funds. And that is actually a contrarian indicator, as you can see on this chart over here. Based on the data that we've had for the last 18 years, whenever the flows into the money market funds is very high, it's usually the local bottom. So yeah, this is an indicator that suggests that we could actually have a rally in the upcoming few weeks. So something to look forward to. And the other indicator is this AAII market sentiment. So basically, it's just asking people how bearish or bullish they are in the coming 6 months. And this is also kind of a contrarian indicator over here. So if you actually backtest this data, you will see that whenever the market sentiment is in the low 20%, so like over here you can see on the 2nd of April, it was about 21.8%. So when this data is very low, it's usually likewise a signal of a local bottom for the market. So if you backtest it, it was the bottom for the 2022 bear market, the COVID crash, the 2018 kind of bear market that we had due to the Trump tariffs, 2008 as well as in 2000. So this is another bullish indicator that we have for the coming few weeks. And the last indicator that we have over here is the correlation between the VIX and the S&P 500. So basically the VIX is the measure of the volatility in the market, and whenever the VIX has passed this threshold over here of 1.2, it has basically signaled the short-term bottom for the stock market. So like I mentioned earlier, no indicator is 100% accurate, but you can see that it actually provides at least a short-term relief for the stock market towards the upside. And one key thing to take note of is you can see that based on the data set that we have over here, the returns in the short term might be mixed. So there's a mix of positive and negative data. However, you can see that the 6-month and the 1 year later return has been positive on the entire data set of about 8 instances over here. Yeah, so this is a very key thing to take note of as well. It's quite likely, based on data that we have, we could actually have a positive stock market in the upcoming 6 months to the 1 year time frame from now. And the 1 year return has actually been pretty good. Other than 2018, you can see that it has mostly been double-digit returns. So this is another bullish indicator that we have moving forward. So for the S&P 500, we did close the week at about $526. So it was quite a short week since Friday was Good Friday and we had a public holiday. So the weekly candle did close about 1.41% towards the downside, and we did get this very bullish candle last week of about 5.67%. So we did retest the previous 2021 high over here before we had the bear market due to the Fed increasing the interest rates. So we got almost a perfect retest of the previous all-time high. And obviously we also had the pump over here due to the pause of the tariffs for the 90 days that Trump announced. And yeah, we did get rejected right at the key resistance at about $550. So this level was basically the previous double bottom before SPY had that huge breakdown when Trump announced the crazy tariff news about 2 weeks ago. And the news that came out I think last Wednesday, where Trump had paused the tariffs, you can see that the rally did get rejected right at the key level over here. And right now we are just more or less trading sideways for about the last 2 weeks. And we do have a few key levels to look out for the upcoming week. So we have the obvious resistance that we need to break above, which is about $547. So this level is basically the previous level, the previous support that we had in March, and we broke down from it on the tariff news, and we retested it as resistance on the withdrawal of the tariff. So this would be the key level to look out for SPY in the upcoming week. We need to break above this level here. If we can get above about, let's say, $550, and if we start to consolidate above it for a couple of days, it's quite likely that the downtrend and the kind of the bear market is over, irregardless of the news, unless we do get some kind of black swan event like China invading Taiwan or something that the markets have not predicted yet. So unless we get some kind of black swan event, it's very likely that the bottom and the bear market, the bottom is in and the bear market would be over, and we'll probably just grind up towards the upside in the coming few months. So for my current portfolio, I'm still all in QQQ. So this is the growth ETF for the US stock market, and I believe that in recessions or in bear markets, this growth ETF would be the best risk reward play. So what we know based on the past data that we have over the last 100 years is that the S&P 500 and the QQQ always returns back to the all-time high, and I don't see that changing in the coming future. I don't believe just because Trump is in administration right now, there's going to be a change in the world order and the US stock market is just going to magically fall off just like that. So I believe that at least in our lifetime, US stocks still continue to do well, and we should eventually return back to the all-time high. So as long as you're not on margin or you're over leverage, I believe that eventually you will actually break even at the very bare minimum. And of course, ideally you should profit. And if you look at the potential returns from where we are right now, from the current price to the all-time high is about a 20 to 25% return depending on the price fluctuation. So yeah, this is not financial advice. Make sure you do your own research, and I'm not your financial advisor, but this is personally what I'm doing with my portfolio right now. So I'll continue to dollar cost average over the next few months, and hopefully we do actually go back and form a double bottom at the technical level that I mentioned earlier. So that'll be another good opportunity to add in more stocks if you actually have the equity available. So yeah, so that'll be it for this video. If you guys like the content, and if you're interested in following me through this journey in the stock market, please do subscribe to the channel, and also do let me know what you guys think about the points that I raised earlier in the video, and I'll see you guys again in the next weekly update. So that's it for now. Take care and have a good week ahead.